Did it just show up on the YouTube page, Junior?
Yeah.
It did? Huh?
Ready to go.
Why you ain't say that, son? Oh, okay. All right. Now that I'm thoroughly frustrated, hopefully, all right, let me share the new link on Instagram. Since I had to take it down. I appreciate y'all patience in here. I appreciate y'all patience online. Now that I've taken up a whole 15 minutes of the thing, we got even less time for me to try to squeeze out as much information as I can. Oh, yeah. Watch live now. Okay. Hit done now. Watch live now. Post that. Let me go back and delete that other one out. Delete this. So nobody don't go to the wrong one. Okay. Watch live now. All right. Welcome to part 3 of Discipline Over Dollars. We started out with, what did we start out with? We started out with, go to your notes. We started out with
basic terminology in finance.
we cooking with Crisco. We started out with
Stock exchanges. Where do we start?
yes. We started out with that stuff. What did we move on to? In the beginning, there was like, I ain't even got nothing I can help y'all cheat with. I can't even, let me see if I ain't even got nothing on my computer I can help y'all cheat with. I can't even help y'all cheat. Okay, we started out in the beginning just talking about stock market in general, the different type of accounts you can have, where you want to put your asset allocations and stuff like that. Last time it was more about like asset allocations. The beginning was like the basics, like what's the stock market, like you were saying, the difference between sectors and industries and, ETFs, as opposed to like companies. We went through all of that, was breaking all that down. Like the stock market as a whole is the big umbrella that everything falls under. Inside the stock market as a whole, you got these places called exchanges. You got the New York Stock Exchange where you can go and actually physically buy and sell stuff. And then you got the NASDAQ where it's computer based and you can exchange on that anywhere in the world. Even go to the New York Stock Exchange and exchange on the NASDAQ. It's computer based. It changed it evolutionized, is that the word I'm looking for? Evolutionized the way we buy and sell commodities and stocks and assets, stuff like that, right? And then you got inside the exchanges where you buy and shop, you have these group of companies, baskets, if you will, called sectors. In the sectors, you got 11 different sectors, and they group the companies together by like their overall arching theme of what they do, like finance, consumer discretionary, tech is like overall. Then you got inside the sectors, you got industries, and industries group the companies together by their specific niches. You know what I'm saying? They may be in finance, but their thing may be like digital finance. They may be in technology, but their thing may be software technology, and these people over here may be hardware type of technology stuff. The industries group them into smaller sections of or smaller baskets, right? You can't buy none of this stuff yet. None of this stuff is something you can actually go buy yet, right? But when you get down inside the industries, that's where all the companies are. You can buy those individual companies, and inside those industries, you got a smaller baskets called ETFs, which is exchange traded funds, and you can buy those ETFs, you can buy those companies, right? So everything, you just come down to smaller and smaller and smaller till you get down to you and me, where we can actually buy these things. That's how it's set up, right? And once you understand that, then you say, okay, now what do I want to do once I start buying this stuff? Well, first of all, I got to set up an account. What type of account you going to set up? This is what we went over the last time. Are we going to set up a Roth? Are we going to set up an IRA? Are we going to set up a regular taxable account? What type of account I'm going to set up, right? Once you figure that out, you set up your account. Once you set up your account, then you want to figure out what's my number, right? What's my number I want to be investing toward? You go out, like we said, we go to the SSA site and figure out what you're going to be getting when you retire based off your work history. If you continue on that path right now, then you go and you put it into the retirement calculator, and it gives you your exact number you need to be investing every year. So you know how much you need to be investing and saving every year, and then you can go on and live your life, right? Once you figure out that number, once you figure out the type of account you want to have, that's when you go full steam ahead and start your investing and your trading, right? And in order to go full steam ahead, you got to have the knowledge about when should I buy and when should I sell. And that's what we're going to be getting into today. That's going to take a whole lot more time than what we got, but I'm going to try to make it as concise as possible, right? So that everybody can understand, you know what I'm saying, where they need to start. Then after that, y'all can tap into Tim's Tidbits on YouTube, because I talk about it every single day. But this right here is just like your foundation. We're going to try to get you there, right? We're going to try to get you there. And because y'all were so helpful to participate, we're going to get y'all some fancy green shirts. I think you was a small, medium. You was a medium. I kind of remember. We're going to get you a medium. And then what size you want back there? Extra large, right? Because y'all were so helpful. Y'all were so helpful. Come on, come. Y'all just go. No, you ain't got to get up. Come on. I was told him he don't have to get up. That's the extra large, Brother Hudson, and then small. There you go. Thank you. Thank you. I mean, medium. Thank you. Thank you. Since y'all were so helpful and participating, right? So, what we're going to be talking about today, all the folk on YouTube, y'all ain't going to see my handsome face no more. I'm going to put the slides up. Woody, make sure the slides changed over for YouTube for me. And make the audio might have went out. Check to make sure the audio ain't go out.
It's a good delay.
It is. It's still, when I switched over? Okay. All right. I just want to make sure. It was looking kind of funny on my side. Okay, discipline over dollars. Y'all know my disclaimer. I'm not a financial advisor, not a fiduciary. Nothing I say should be considered as taking as financial advice. Do your own research. That's why we're doing discipline over dollars. So you know how to do your own research, right? That's the most important part. Even if you don't want to do this for yourself, when you go talk to a financial advisor and or a fiduciary, you want to make sure, hey, they not pulling the woolly cloth over my eyes. They know what they talk about. They're not trying to get over on me. And everybody know investing involves considerable risk, and you should always consult a financial before making any investment decisions, right? That includes buying a car, buying a house, you know what I'm saying, getting ready to send a child to college. Anything financial, you should talk to a financial advisor about it, because they can help you do it the most practical way. And if it's a taxable event, they can help you save the most amount on tax. Talking to my financial advisor opened my eyes to a lot of stuff that I should have been talking to a financial advisor about in the past. So with that being said, we're going to be talking about technical analysis, right? If I breeze through kind of quick, I jollipize. Just say, Tim, can you slow down a little bit? Can you slow down a little bit? But technical analysis, do anybody want to take a stab at what they think technical analysis is? You got fundamental analysis. When we look at the companies, we look at like the economic data, how the company's doing on they cash sheets, what their balance sheets look like. It's everything like their leadership. You're looking at everything fundamentally about the company. That's fundamental analysis. That's what make you want to invest in them from a fundamental standpoint. So what do you think technical analysis is, right? What do you think it entails? It ain't no wrong answer, just somebody guess. What do you think technical analysis, if the fundamental analysis is everything that makes you love the company fundamentally, right? The technical analysis, what do you think that is? Just take a stab at it. It's real easy. When you're looking at buying something, what's the most important thing? The price. You're just looking at the price moving, right? You're looking at the price. That's all you're doing. You're looking at the price move. What slide y'all on? Yep. You're looking at the price moving. Did my thing disappear? Am I still good, Junior? Okay. All right. You're looking at the price movement and the volume, right? And what volume is the amount of the asset being bought and sold at a particular time and how much the price is. So I like to say technical analysis is the fundamental data laid out on a chart, because how the company is doing fundamentally affects the price. And the price goes up and down. So the technical analysis is the fundamental data laid out on a chart, right? Right. Everybody tracking with that? Right. And why use technical analysis? Like I say, you want to figure out when you want to buy it and sell it. You want to determine price trends. What trends are is when it's going up or down in a continuous time. That's a trend, right? If it's going up for a continuous time, that's an uptrend. If it's going down for a continuous time, that's a downtrend, right? It's like you can visually identify buying opportunities or selling opportunities. You can visually see the headwinds. Like sometimes you hear all this this fundamental information on CNBC and Yahoo Finance and all. You hear this stuff and it's like you be like, man, is that good or bad? They may say it's good, but then you're looking at the technicals and the price still dropping. You know what I'm saying? You're like, okay, I thought that was good, but you can visually see, okay, that ain't good for the price. And you can start to learn what's good for this asset and what's not good for this asset. When the feds come out and talk about raising interest rates, you might see the company you're interested in, it might start you're looking at the chart and start diving. It's just the fundamental analysis laid out over charts, and it's easier to watch it visually, right? And overbought and oversold, that means people buying it too much or selling it too much. Being oversold, that's a good buying opportunity to some people. And being overbought, that's a time to kind of step away and take some profits, because they buying it so much, the price running up. So they're going to start selling it. It's going to start coming down, right? So here goes some more common terms. This is where we're going to get into the meat and potatoes. The main one we're going to focus on out of all these right here. And oh yeah, as always, if you go to my Instagram page and click on the Linktree link, you will see a rectangle on there that say discipline over dollar slides, and you can download the slides for free, share them with friends and family, all of that, right? We're going to focus on candlesticks and we're going to focus on gaps. That's the primary ones we're going to focus on. Candlesticks is a type of price chart that displays the high, low, open, and closing price for a specific period. Whenever you look at a candlestick, you're seeing the high, the low, the open, and close of the price for that time period. If you look at a 1 minute chart, if you look at a monthly chart, if you look at a weekly chart, every candlestick on there is telling you the same thing. It's just different periods of time that it's telling it to you for. Right. And we're going to talk about gaps. The reason we're going to talk about gaps is because the type of entry setup, if you will, that I'm going to share with you, I didn't create it. It's something that I learned from a guy named Michael. They call him ICT, the inner circle trader is very effective. Is the way you're looking at it, in the way that the algorithms that run the system look at it. So it's a very effective way to decide when you want to buy and sell an asset. You know what I'm saying? So that's why I like to focus on that. I want to focus on the candlesticks and the gaps, because you have to understand the candlesticks. You got to understand the gaps. In other terms, don't worry about moving averages, really. That you can worry about it if you want to, but that's just something that some investors like to use, because a moving average, it takes the average of the price over a certain period. And if you change it on days, it'll be a 20-day moving average. If you change it to hours, it'll be a 20-hour moving average. If you change it to months, it'll be 20 months. It go back the previous, whatever the number you're looking at, it goes back that many candles on that time frame and gives you the average and plots the average out on a line. And it, it just shows you the average price over that time, right? Gaps is a place where if the market moves so fast, it skips people. So it'll be a gap. You can have a full gap, or you can have an imbalance that Michael calls a fair value gap. And I'll show those in a minute. Right? Any questions? Am I moving too quick for anybody? I can't slow down. All right, these are candlesticks, right? These are all the, pretty much this is every type of candlestick you'll see. Like the little chunks. The little chunks called the body of the candle. It may be in a slightly different position on the line. The lines are called wicks, because you have a top wick and a bottom wick, right? And so these are the only candlesticks you will see, right? The big ones, it's either very bullish or very bearish. Bullish are the green ones. The bearish are the red ones, right? Green means what? Up. Red means what? Down. There you go. Increase, decrease. There you go. We got fancy words, right? So, like I say, you know the opening price, the closing price, the high price for the period, the low price for the period. And one other thing the candlestick shows you is the market sentiment for the period, right? So if you see like the big red candle to the left at the top in the candlesticks, right? And then the little red candle to, let's just say, okay, the big red candle to the left and the big green candle to the left. Who could tell me what's the market sentiment for those two candles, right? The big red candle means what? And it's going down what? It's very what? It's very bearish. It's going down very bearish. It's like the market sentiment is like sell, 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 because it's very big. It's a lot of volume. It's going down, right? The green one, the sentiment is very bullish, because it don't even have a wick. It started here and it took off and it never looked back. The same one with the red, when it started here and it took off to the bottom, never looked back, right? So let me show you on the next slide so how you can identify the actual points. The only difference between the red candles and the green candles is where the open is on the body. If it's a green candle, that means it closed higher than it opened. If it's a red candle, that means it closed lower than it opened, right? So when the price opened up for that period on a green candle, right, even if it went down and made a wick at the bottom, right, that's the low. Then it went up, it made a wick at the top, that's the high. Then it might have come back down a little bit and then closed, but it closed above where it opened. With the red candles, it could have went down, made a wick at the bottom, that's a low, went up, made a wick at the top, came down and it closed below where it opened. Boom, that candle gonna be red because it closed below where it opened. But every candle you look at, you can see where it opened, how low it went, how high it went, and where it closed at, right? And if you got a really fat candle with no wick at the top and the bottom, it still has a high and a low. It just started at the high and ended at the low, or started at the low and ended at the high. That's all it means. There's still a low and a high there, but if it don't have a wick, it just means it either was very bearish and it never went up, or it was very bullish and it never went down. It started and took off, or started and took off. There's still a low and a high there, but if there's no wick, that just means it just didn't go in that direction for that time period. All right? Everybody tracking so far?
Yeah, well, I got a question. I got what you're saying there, but sometimes I've seen these things where, you know, it's a red one, green one, red one, green one. Over time period, I don't understand that. Can you help me on that one?
Yeah, we're going to get there.
Okay.
We're going to get there. I'm glad you said that. We're going to get there. We definitely going to get there. We hit that one. Okay, and we already talked about this. The only thing we didn't talk about is what they call a doji candle. That's the one in the middle. It's a candle of indecision. It's a candle of indecision. You open and close in the exact same spot. You know what I'm saying? A lot of people call any candle that look like that a doji, but if it has a color, if it's red or green, it didn't close in the exact same spot. It was very close. And that's close enough for government work. So they say, okay, that's an indecision candle. That's a doji, because it's so close. It's close enough for government work. All right. But if it open and close in the exact same spot, the candle won't have color. It won't be green. It won't be red, because it opened and closed in the exact same spot. But you still know where it went as high, where it went as low, where it opened and it closed. It still give you the same information. The sentiment is just undecided. They don't know where they want to go, up or down. Right? They don't. It's like we did a whole lot of upside, we did a whole lot of downside, but we just closed in the same spot. So it's indecision for that time period. Right? Any questions about that? Boom. Gaps, right? You have different type of gaps on this. They got a million different names for gaps. Just call them gaps. Don't worry about breakaway, runaway, exhaustion, gaps, right? And so you have full gaps, which is a 2 candle pattern, where, as you see where I circle them, the first one that I circle, a gap up, that means price was going up and it stopped, and the next candle, when it opened, it jumped up and skipped a whole lot of people. So it's a gap. A lot of people got skipped in that spot. All the algo traders that they had their price sitting at $50 and it closed at 45 and then opened up at 55, they got skipped. So the market going to eventually come back and get them, but they got skipped because it was so much momentum to the upside. When that period ended, it's like the algos couldn't keep up with the momentum and they gapped up. And then so now they got to go back and get them people eventually. Gap down is the same thing. You're coming down with the momentum and then you gap down and you skip people. It's a full gap between 2 candles where they don't share price, right? That's a full gap, right? A fair value gap or an imbalance. What I was talking about, the ones that I look at the most, the ones that's going to be entailed in the entry and exit setup that I'm going to be telling y'all about today. It's called the imbalance. It's called the fair value gap. I got the term fair value gap from Michael, the inner circle trader. Some people just call them gaps. You know what I'm saying? It's a gap, right? But it's a 3 candle pattern where candle 1 and candle 3 don't share price, right? And if you look at the screen, you see how I got a little rectangle connected to candle 1's wick on the bottom, candle 1's low, and then candle 3's high. That little space in between that, even though it's going through candle 2, candle 1 and 3 should have overlapped, because what price does, price goes down and it goes up. It goes down and it goes up. And when it, and shout out ICT again, he say, look at it as rolling a paintbrush. When you're painting a wall, it's like when you roll up and roll down, eventually the paint starts to thin out and you start seeing patches. That's what's happening with them gaps. When it starts to thin out and you start seeing the patches, the algo's gonna go back and try to rebalance that. They're gonna try to get back and make sure they got everybody up. I like to call it wax on, wax off, like the Karate Kid. You wax on, you wax off. You wax on, you wax off, right? I like to call it wax on and wax off. And it can be to the upside or the downside. They just happen to be both going down on this one, but they can be to the upside or the downside. Candle 1 gonna always be to the left. Candle 3 gonna always be to the right. Even if you're going up or down, it's all because price reads, you read price just like you read a book from left to right. Price prints from left to right, right? So to what Doc was saying, I may have a slide in there about this, but just in case I don't, I want to do it here while we got the price on the screen. While we got the candles on the screen. Price can only do 3 things. It can go up, it can go down, it can consolidate, right? If price is going up, right, you're going to see it continuously making higher highs, right? Like over a period of time, it's continuously making higher highs. If it's going down, it's continuously making lower lows. If it's consolidating, it's in a range. It's going to be making lows and highs, but overall, because you see how right here in the middle, how it's consolidating to the left, it's coming up. In the middle, it's just kind of going sideways. It's making lows and highs in there, but it's just going sideways. Then it go up again, and then it start going down again. So price can only do 3 things: go up, down, or consolidate, right? And you start to understand that, like when you're looking at it, when you're looking at the charts, once you start to it starts to click in your head, like where the open for the period is, where the close is for the period, where the high and the low is. You can start to see, okay, price doing good right now. You know, I want to get in, but I'm gonna wait for a little pullback. And then when you get to the far right over there and it start going down, you be like, okay, it's pulling back. Let me see if it's pulling back to a good level that I want to buy. You know, and then if it's pulling back to a good level you want to buy, then you may start scaling in. And then when it start going back up again, you be like, okay, is it going to a point where I need to start taking a little profits and moving it over to another sector, another company? You know, you start to learn how to see that, you know, in real time. And we call that reading the price action, right? The price action, reading the charts. We call that reading the price action, right? And the price action is just the movement of the price plotted over time. And this is a chart of the NASDAQ futures, right? You're looking at that price over time. So you're reading the price action. You're looking at the price action over time, right? What are you looking for when you're reading the price action, right? When you're reading the price action, you're looking for where the liquidity is lying, right? You want to know where is the liquidity at on the chart? Where are the algos trying to get the liquidity? Well, Tim, what's liquidity? I'm glad you asked that question, little Timmy Rogers. Y'all didn't think little Timmy Rogers was going to show up today, but he did. Liquidity is money. Liquidity is money. The algos are looking for the money, right? Where is the money? The money can be hidden in buy stops. The money can be hidden in sell stops, and the money can be hidden in those gaps. So it's looking for this money at all these places, right? Buy stops are like your stops that's above highs, because when you sell the market, right, it's all about risk management. You only got a certain amount you're willing to lose, right? So when you sell the market, you put your buy stop. When you sell something, in order to get out, you have to buy it back. So when you sell the market, you put your buy stop above old highs. Let me go back. You see the points of the wicks, right? Right. If you went short on a I need to walk over here. If you sold the market, right? If you sold the market right here and you want to sell it down, right? Where would you put your buy stop? Where do you think you're going to put your buy stop? You're going to hide it where? Above the previous high, right? You follow me? So if you sold the market here, you're going to put your buy stop up there above that previous high, right? So that you feel like it's safe up there. You're not going to put, if you sell the market here, you're not going to put your buy stop here, because you know the market went up there one time before, right? So you said, okay, I want to put it where I think the market not going to go anymore, because it went up there and it came down violently. You see what I'm saying? So it's like, oh, it probably won't go back up there for a good deal of time. So you hide your buy stop up there. So when the market does its due all this time, eventually, guess what? It comes back and it gets you. It comes back and it's looking for that liquidity. The market, it's like it comes down, it looked for liquidity down here. And once it got its liquidity down here, it said, oh yeah, it's some more liquidity up there because I stopped there the last time. So I know some people hit they stops up there. So when it come down here and run all these people out that was up hiding, they sell stops under here, came and ran them out, going back over there to get them that hit they buy stops on that side. The market always looking for liquidity. It's always looking for liquidity. And for everybody on YouTube, when I was like on this side and that side, I was talking about the wick, the big wick to the left, and then it ran and got that big wick when it got to the right. So that's buy stops, sell stops, liquidity, fair value, and it's hitting in fair value gaps too. Because like I say, people got skipped. So when you get skipped, there's money in there. Is liquidity in there that the market gonna go back and try to get, right? Talked about buy stops, talked about sell stops, swing highs and swing lows. When I say hitting above highs and hitting above lows, swing highs and swing lows, right? Both of them are three candle patterns, right? If it's a swing high, the candle in the middle, right? Candle number 2 has a lower high to the left and a lower high to the right. I'll show you on the screen in a minute, right? A swing low, the candle in the middle, candle number 2, has a higher low to the left and a higher low to the right. It's a swing low and a swing high. That's how you remember it. It's like it swing high and then it swing low. The price, you know what I'm saying? And if you look at the, and then gaps, we talked about that breaking market structure. That's another one that we're gonna touch on that's important. A breaking market structure, it was when price trades through a swing in the opposite direction. When the price passes by a swing low or a swing high, like if you have a swing low, then price pass by that, that's a breaking market structure. I'll show you on the screen. And if you pass by a swing high, that's a breaking market structure, right? A breaking market structure can be just a temporary shift. A breaking market structure can be a change in the trend, but it's about what time frame that is breaking that market structure on, right? Any questions on any of that yet? Am I losing anybody? Did that answer your question about the green and the red when?
Yeah.
Okay.
And I got another question about, like, when you're seeing that does it tell you how do you use that to tell you when I need to buy?
We're gonna get into that. That's coming up. That's coming up right here. Okay. You right on time. Whenever you read in the price section, you want to know, and for everybody on YouTube that couldn't hear, the gentleman asks, when you see the price moving, how do you use that to figure out, okay, when do I buy? And the question you want to ask while you're reading the chart is, where is price trying to get to? Right? If y'all see my little Brinks trucks that I put on there at the top, it say liquidity picked up, right? And if you look at the bottom, it say liquidity delivered, right? What does that mean? That means it went up and it took out all the highs or lows. It works in the inverse too. It went up and the algos took out all the highs that it was seeking to take out at that time, and they got enough buy stops have been taken, and now it's time to go down and start taking out sell stops. And when they go all the way down and they take out all the sell stops that they're seeking at that time, they reverse course and start going back looking for more buy stops, right? And what you want to do when you're reading the charts, you want to figure out, where do I want to get in? Where am I going to take this entry, right? So when I don't know if you can, I ain't gonna be able to point at it on YouTube, but everybody in here, let me break down. Let me switch back over. Let me switch it back like this right here. Junior, do me a favor. Go back there and zoom the lens out. Come on. Go back there and zoom the lens out so that I can see the screen. You ain't got to move, just like start zooming it back. Like widen it. Look at the screen while you're doing it. Okay. Zoom it in just a little bit. Zoom it in a little bit and turn. Right there. Yeah, you got to loosen up the little thing on the bottom. No. Right there. Keep coming around. Keep right there. No, go down one. Yeah, loosen it up so that you can turn it a little bit. A little bit more. Right there. All right. Go back. Go back some more. Just get. Yeah. Go. Yeah. All right. Right there. Zooming in just a little bit. In. Yeah. Okay. All right, raise it up some. Get like the screen. I'm trying to get the screen in. All right, that's good right there. That's good right there. Okay, so, all right, so when we're looking at price, right? So what price did? We came up, came down, right? Some people hit some stops under there. They wicked up, they came up, these stops got taken out. That's a breaking market structure right there. All right, we're gonna get more into that. We're going up because it's a breaking market structure because we formed the swing high, right? And then we traded up past it. Boom, that's a breaking market structure there, right? If you notice, we came back and we test that breaking market structure. This is a fair value gap in here. So you come down, you testing that, boom, it's doing that. We're gonna get into all that. Price going down, it set a low, right? We done ran up under these stops under here, right? We set a low right there, boom, we start going up. Got several breaks in market structures. We going up, right? We get up there to the top, right? And you can tell the liquidity was picked up there, right? Because of how far it came down. Now, you're not going to know this in real time, right? You just have to learn how to read it, and you want to set your exit points, right? No matter what time frame you're looking at, you always want to know your entry and set your exits, right? So I'm gonna give you a quick overview of the entry that I was talking about, and then we're gonna break it down a little bit more, right? So you see, when we going up there with a Brinks truck, it like we done ran over all these highs, right? We got above all these highs, right? And you see here, we came down, we took off, and then we just consolidated at the top up there. So the market trying to decide which way I wanna go, right? The market always gonna let you know which way it wanna go. It's gonna go up, it's gonna consolidate a little bit, right? And then it's gonna show you. How does it show you? It gives you a violent breaking structure, right? You see this little area right here where you got that swing low right there? You got a swing low there, and you got this candle that violently breaks out of that consolidation. That's the market saying, hey, I'm ready to go down. If it break it to the upside, it's saying, hey, I'm ready to go up, right? So you got your breaking structure right there. Then you notice your breaking structure. And then if you notice right here, what do we have right here? Right? What do you call that? 3 candle pattern. 1, 2, 3. 1 and 2 not touching. What do you call that right there? Fair value gap. 1 and 3 not touching. I mean, you got 1, 2, 3. Right? It's a space in between there. That's a fair value gap, right? You got a breaking structure. You got a fair value gap right there. When the price trade back up into that fair value gap, you're gonna be looking to enter on that fair value gap somewhere. That's like one way you can say, okay, this is a spot where I wanna sell the market, right? The opposite way would be, this is a spot where I want to buy the market. You know what I'm saying? Here, right here, it came back close to the breaking structure, but it didn't quite get inside that fair value gap until later on. You see what I'm saying? It came back to it, but it didn't get back down to it until later on, and it went to run these stops. But the market always come back to revisit this stuff, right? So you want to decide where you want to get in and where you want to get out. Now let me show you how you figure that out. Right? You always want to know your entries and your exits, right? You always want to know your entries and your exits, right? So you see up here, we got our fair value gap. We got our breaking structure, right? You entering when you get in the fair value gap. In this case, it's selling the market, but it's the same thing buying it, right? And then how do you know your targets, right? You look for your low hanging fruit. Where do they hide the liquidity? In fair value gaps, below lows, above highs, right? So if you're a seller here, your first low hanging fruit is that low right there. Cause somebody who went long here to take this ride up from here and go up there, right? They hit they buy stops up under there. So it went up, came down, boom, took them out the game, right? Your next low hanging fruit is this low over here. Came down, took them out the game, right? And when you're coming down like this right here, boom, it's giving you breaking structures to the downside. You got a breaking structure to the downside. Got a breaking structure to the downside. These are all spots where you could be targets of taking your profits to the downside, right? Then once the market gets as far as it want to go, right, it's going to show you I'm ready to go back the other way, right? We get down here at the bottom, then what you start doing, now you got a breaking market structure to the upside, right? You go up, you come back and you testing that breaking structure right here, boom. And then it's slowly going back up. The market, I know it may sound complex or it may sound easy, but that's all it is. That's all it is. It's like once you understand, once you learn how to read the candles, as you see, it just repeats over and over. It go down, it go up, but the market is always hunting liquidity, right? It's always hunting liquidity. So you're looking at it as, okay, these are, let's just say these are daily candles, right? And let's just say this is where we at in real time. Just say it went down here and you'd be like, okay, that was a great price, but I missed that price, right? And it's coming, now it's starting to consolidate right here. So we came up, we got a breaking structure right there. We came up and now we consolidating. Cause you see the price just moving to the side, right? This right here is showing you that the market ready to go up, right? You saying, okay, this was a good price. I wanted to buy some more shares of this company right there, right? You don't want to buy it in the consolidation, right? You don't want to buy the consolidation. You don't want to buy it when it's falling. You want to sell it when it's falling. We're going to talk about options real quick because we're running out of time, but you don't want to buy it when it's consolidating. You want to wait till the market show you I'm ready to go up, right? Once it show you I'm ready to go up, and then you're going to make your entry either based off of a breakout or a pullback, right? That's up to you how you want to enter. If it break out and you say I'm gonna go in as soon as it break out, when it break out, that's when you buy. If it break out and you say I'm gonna wait for a retest, and what a retest is remember when I told you how when it I said it retest the breaking structure. Where we was at? Let me get over here, right here. See, right here we was coming over here, we came down and we broke structure to the upside. But when we got here, we came back down to this breaking structure. That's called the retest. When it come back to the spot where it broke above, that's a retest. If you say I want to get in on that retest, then you'll wait for it to break out and then come back and retest. Then you'd be like, that's when I'm gonna buy. Or you say I'm gonna wait for it to break out and I'm gonna buy when it break out, right? It's just up to your investing style to let you know, but you don't want to buy it when it's just going sideways. That's just dead money, right? Unless you just dollar cost averaging. But if you're trying to, get the best bang for your buck and have your money work more efficiently, you try to put your money to work when it's not just dead money. It's not just sitting there not doing anything, right? So I know it's probably a million questions on that, but is it any question? Is it any questions? Anybody got any questions on that? All right. We real short on time, so I'm just gonna kind of introduce this right here, and I ain't gonna go super in depth on it like I wanted to. But options. Let me switch this back over to here so y'all can see the slides a little bit better on YouTube. Options give you the opportunity to make money when the market going up and down, right? And you buy options the same way when you're looking at the chart to know when you want to buy your shares. The only difference with options, you can buy what they call, let me come here, options. An option contract offer the buyer the opportunity to buy or sell the underlying asset at a future date on an agreed price. When you buy options, what you're saying is, I want to buy 100 shares of this at this point in time in the future for this agreed upon price. Now, you don't have to buy it, you know what I'm saying? But if you want to buy it, using options is a way to help you leverage your money to buy it, right? But you don't have to buy it. You can just go into that contract, and then when it goes in your direction, you can just close that contract and profit off of the volatility in the moves. You don't never have to own those shares of that company. You can just profit off of controlling the shares, because the option contract lets you control the shares, right? And the different types of contracts you can buy are calls and puts. If you think it's going up, you buy calls. If you think it's going down, you buy puts. Right? It's bullish and bearish. If you buy a call, you need the price to increase to make your money. If you buy a put, you need the price to decrease to make your money, right? And then everything dealing with options is times 100, because you're controlling 100 shares, right? So if you see an option premium that says $3, that means you have to put up $300 to enter into that contract. Right. And when they say enter in the contract, it's the same thing when you go on and buy a share or something. You just go onto your platform and you buy that call or you buy that put. But that's entering you into that contract. Right. And so you're buying, everything is time 100. Everything you see is times 100. Right. And then you got a break even point so that when you're intending on exercising your options, your break even point is for a call is when the price equals the underlying price equals the strike price plus the premium you paid. So if you buy a 350 call for $3, once the price gets to 353, that's your break even point. Right? That means that's the strike price plus what you paid. That's your break even point, meaning on expiration date, if it's at this price, I'm at break even. I didn't make no money. I didn't lose no money on this contract. Right? But if it's well above that price, then you got intrinsic value that you can use in turn to buy those shares if you want to buy them. Because if you buy a strike price at 350 and now when your option expire, it's at 450, they have to sell you 100 shares at $350 a piece, because that's what the contract said. Even though the price is at 450, they have to sell it to you at 350, right? 100 shares of it. So now you got $100 worth of intrinsic value for your shares when you buy them at 350, right? And then what my thing is, buying long-term leaps, either a year out or 2 years out, to leverage the capital to invest long-term, right? So how you do that right there? I got a simple thing that I drew up for this right here. We just pretending, okay, you got $20,000 to buy the SPY, right? If you took them $20,000 and at the price that it's trading at that time when I took this, we see it's at the top. You're not going to buy at the top. So we're just pretending that it's in a nice pullback. It's at a nice spot where you want to say, oh, I want to buy this. It has pulled back whatever percentage I wanted it to. So I'm going to buy these shares. I'm going to put this 20,000 in, right? If you use 20,000 and you could buy 42 shares, right? You can buy 42 shares. And then in this example, we're projecting that it increases by $115. The price of the stock increased by $115, right? You bought 42 shares and it increased to $115. That means it's $115 per share you bought that you got in equity now, right? So that's $4,830 in equity. Everybody tracking so far, right? So my thing is, if it's done a pullback and you believe in this stock, right? Instead of buying the shares right now, you want to buy these shares anyway. Instead of buying the shares right now, right? You could take that 20,000, and don't take the 20,000 if it's your whole portfolio, right? If you wanted to invest that 20,000 in this right here, I'm just using these numbers, right? If you buy, it's trading at 475 right now, right? And you thinking it can get to, you projecting it to get to, wherever it was getting, because that's what the trend lines were showing. We're projecting it to get out a conservative projection was 24%, right? Based off of how it was trading. Like in that year, it went up 27% in 1 year. And then the conservative projection over the next 2 years was 24% because it went up 27 in 1 year. So you're just being very conservative of where you're projecting it to go, right? So you're projecting it to move 24% in 2 years, very conservatively, right? So when you buy your option, you're buying an option for 10% out the money, meaning it hasn't gotten to this price yet. And it's like, okay, it ain't get to that price yet, but I know it's going to go well beyond that. I'm projecting it to go 24% in 2 years. The track record is 27% in 1 year, but I'm buying this for 10% out of the money because I expect it to go well beyond that, right? So 10% out the money, it's like 522. I think I use 525 or 520. I use 520 in the example because 10% from where it is now at the price you want to buy, not at the high like it is on the screen, but that's the only screenshot I had, right? So we're pretending it has pulled back. This is a good price I want to buy, right? Instead of taking the 20,000 and buying those 42 shares, right? You take the 10,000 and buy 2-year leap options, 10% out of the money, meaning you're going to buy a 520 strike, right, for 2 years from now, right? You're buying a 520, meaning I think the price is going to get to $520 within these 2 years, right? So you buy everybody follow me so far? You buy the 520 strike, right? When you buy the 520 strike, right, we're just looking at the chain and just say it costs $3,200 per contract. Right? So that means you can buy 6 contracts with the $20,000, right? So you buy the 6 contracts and over time it moved them $115, right? The price moved them $115, right? So over time it moved them $115. This ain't exact because you can't do it exact, but I'm simulating a move by just backing up $115. Right, I'm backing up $115 up the chain. So if I go back $115 up the chain from where it was at the time, you see the price. We're pretending that we've moved $115, and now they're $102 per contract instead of $32 per contract. Right. So now it's in the future. Now your contracts are worth $102, whereas you paid $32 for them when you first bought them, right? So now $102 times, you know what I'm saying, 100, right? So you got, it moved to $115, right? It's $102 move, right? So that's $10,200. You know what I'm saying? It's $10,200 per contract that it increased. You paid $3,200 per contract, but now they're worth $10,200 per contract because that $115 move in the stock price, right? The difference in the options, it moved from $32 to $102. That $115 move, because we at the time it was trading, we just moved back up the chain $115. Am I losing anybody on that? Everybody tracking with that? Okay, so now with that, you got $61,200, right? You subtract the $20,000 that you started with, and so now that's $41,000 in profit, right? That's $41,000 in profit, right? So what can you do if you really wanted to buy those shares, right? If you really want to buy those shares, what you would do, you would exercise, right, one contract, right? You would exercise one contract. You would say, I want to buy 100 shares of this, right? I want to buy 100 shares of this. So now you got 6 contracts that's worth $10,200, right? That's $61,200. They have to sell you those shares at $520 because that's what your contract said, right? So 100 shares, that would be $52,000, right? So you take the $52,000 and you buy the 100 shares, right? That leaves you with $9,200 in cash, right? And then your positions that you bought, you now have $7,000 in equity because the price is at $590 now. You understand what I'm saying? It's at $590 now, right? You bought, you still want to buy it, but you're buying 100 shares instead of 42 because you initially was going to buy 42 with the 20,000, right? You buy the options contract, leverage the money. Now you can buy 100 shares and now you got $7,000 in equity as opposed to the 4,300, 4,800. And then you got 9,200 in cash left over because you used the options to leverage your money to invest when you know what I'm saying, to invest it long term. That's how the options work. I know that's a big pill to swallow. That's just and that's a comparison chart right there of buying the shares up front with the 20,000 and then using the options to leverage it and then buying 100 shares with the money. That's a comparison chart. And like I say, this is like just a simulated event, but this is how it actually works. This is how the using the options work. And the only thing you do is read the price action. And when you get to a certain pullback, instead of saying, okay, I want to buy the shares now, you would just buy the options and then exercise your option later, right? But if you don't want to play the options, you just buy the shares. You know, I want to buy the shares during this time. And then the other way is just dollar cost averaging and just, you know, putting money in every week, every month, and just buying it over and over for the same amount, right? Those are just the different ways you can do it. I know that was a whole lot of technical analysis. I opened up the water hose. Like I say, if you tap into my YouTube page with Tim's Tidbits, I go live every single day. I go live in the morning about 9 o'clock, and then I go live in the evening, usually 6:30, but during football season, I'm doing it at 7:30 because I got to pick up Junior. But I just talk about the price action every single day. And that's all I talk about every single day. So if you want to tap in and learn some price action stuff and get like a better feel for how this stuff actually work in real time, please join me on youtube.com/thenewTLR. Do we got any questions? Cause yeah, we good and over the time, but I got it for a little bit longer so I can break down. Do we got any questions? Do anybody want some shirts? I got plenty of shirts. I got one extra large, 2 large, 1 medium, and 2 smalls. Extra large. Chris. Anybody else want one? Want a shirt, Doc? Medium. Large. Water. Come on, Water. That's the medium.
Medium.
Doc. I appreciate y'all. Y'all got any questions? Anybody got any questions? That's all I got. Y'all got any questions?
Okay, I got one.
Yes.
So with the whole 20,000 concept, just to make sure I'm getting it right, do you put down 20,000 when you're doing like the option stock, or do you just put down like the fraction of the cost?
Whatever the premium is, that's a good question. For anybody that's still watching on YouTube, she asked, for this example with the 20,000, do you put up a certain amount, or is that what you put up? When it comes to options, you're putting up whatever the premium is. So like, let's go back to the premium slide. Okay, we can use that one right there. Am I doing it on the wrong screen? I think I was. What screen y'all on? 6 contracts. Okay. Yes, that's it. So if you're looking at, let me put this back on here for YouTube so y'all can see it. Oh yeah, there it is. It's changing. I'm like, why is it not changing? It's a little delay. There it is. All right. So if you look at this right here is called the options chain, right? This is an options chain. And over here, let me find the strike. See where it says strike? The strike is the price that you're saying, I think the stock is going to go to, right? And over here, this is the premiums, right? This right here, this is the ask, the bid, and the midpoint. Right, this is the lowest somebody willing to sell it for. This the most somebody willing to pay for, and then where it meet in the middle, that's where you usually get filled at, right? So if you're looking at this right here, and you look at, for our example, we was looking at a 520 strike, right? We were saying at the time it was trading at where is it on this chain? It was trading at $475 up there. It was trading at $475, and we were saying we think it's going to get to 520. Now, to answer your question, right, this is what you, right now, the midpoint is there, but this was the last price that it paid. So you're paying roughly $3,200 per contract, right? So what that means is, out of the money that you have to invest, you have to decide, how many contracts do I want to buy? Right. So you got, and for this example, we were trying to invest 20,000. That's why I say don't invest 20,000 if that's your whole portfolio. You invest the portion that you want to invest at that time. Right. You say, how many contracts can I buy with that money? So whatever the premium is, that's how much you're putting up. Like if you got $50,000 in your account, you're not going to go put $20,000 on one trade, right? You're going to decide what percentage of my portfolio am I going to put into this trade, and then the premium you pay, that's how much you got to put up. And it's not like a margin thing where you put up a certain amount and then you can go into the, on futures, it does that. On futures, you put up $500 intraday margin and you can trade this contract, but you got to close it before that day is out. Right. But you only have to put up 5,000 to go into the trade. But that's with futures. That's something different. But with the options, you're going to pay whatever the premium is. And if you're trying to invest 20,000, you will just divide 20,000 by this 3260, and that'll let you know how many contracts you can buy with that 20,000. Right. And in an example, I think we used 3,200 and we could get 6 contracts off of that 20,000 with a little money left over. You know what I'm saying? Did I answer your question? Okay. And then you don't have to hold it to the end. With options, you don't have to hold it to the end. Let's just say within 6 months, it went up to 590, right? Your contracts will be worth a lot more than the 102, because the 102, we were simulating that as the price of at the end. When you're all the way to the end of your contract, you ain't got no more time value, and that would be the price that is worth. But if the price shot from here up $115 in 6 months, it would be a whole lot more than 102, because you still got a year and a half worth of time that's making that contract more valuable, because you still have time. So it depends on how fast it moves, how quickly the money is going to multiply. If you hold it all the way to the end, the time value goes to 0 and you don't have any time value. You only have the amount of value between where your strike is and where the price is trading. That's the only value you have in your option at the end of your contract. But before your contract ends, you have the difference between where your strike is to where the cost is trading, plus the time, like the time value. And there's like all these trigonometry things they use to figure out the time value, but the farther out in time it is, you see how this says it's like $3,200, right? Because that's for it's like looking at 2024, and this right here was back on 2021. So it's worth it. They was charging 3,200 for this strike price right there because they saying, well, we got 2 years to go, so we got to charge a lot for this because it might hit that price. So if it go past that price really fast, the option gonna have a lot more value in it. You see, and then you could just close it out. That's how people make money on options, because they say they profiting on the volatility in between the moves. They're profiting on the volatility in between the moves where they where it's like you looking at, just say you buying a strike here these 2 years out, but just say if you're looking at like a 3-month option, right? And you're looking to buy a 3-month option, it may be $600 to buy that, but to buy that 3-month option, right? Maybe $1,500 to buy that 3-month option, right? But if the price increased by $10 over the next week, right? The price of that, the value of that is going to increase because you've moved in price up. You moved up $10. Let's just say we moved up. That's the $10 move right there. Just pretending it went from 56 to 66, right? But you still got a whole lot more time in there. So you're going to have time value on there. So the price may very well be 71 because you still got a lot of time before it get to that. So you got that $10 in value plus the time. So it may be 71, but that's how people profit off of the options. If they buy a call and it move up fast, they just close their position and take their profit. Right? If they buy a put and it move down fast, they just close the position and take their profit. Most options buyers, options traders never plan on buying those stock. They just make the money off of the move. And a lot of people say options is more risky than buying stocks. Only reason I feel like they say that is because you have an expiration date. When you buy the stocks, you don't have an expiration date. So if the price go against you, all you got to do is hold it until the price come back. With options, if the price go against you, if you didn't buy enough time, you have to close that position. That's why I tell people, just buy it 1 or 2 years out, because the price going to do this right here. It's going to do that. But the market is rigged to stay up. Long as you're not buying at the high, long as you're buying once you got a decent pullback and the market starting to reverse, it's giving you the reversal signs that you learn how to read on the price action, and you buy it a year or two out, right? You can close it 6 months later and just take your profit. Or I advise holding it for at least a year and a day so that the capital tax will be long term instead of short term. You know, but you don't have to hold it the whole time.
Tim,
Yeah.
Audrey B said, great job. Kirk Max 75 got fired. Rick the Tank, whoever he is, say, wow, in all caps, this is gold. Thank you, Timothy, for teaching us how to fish. Thank you, sir.
You're welcome. Them names,
Rick the Tank.
them names ain't familiar to me, but I appreciate y'all. I be trying to remember the names of the people in the Spider Gang.
I know.
But
Here
to learn and share, that's the teacher's favorite.
Yeah, whoever they are, they said thank you for what you do.
What's going on here to learn and share? You the teacher's favorite.
Well, Kirky Max 75, whoever that is, I don't know.
Yeah. I appreciate y'all for tapping in. Hey, any other questions about anything we covered today? Price action, candlesticks, options, anything, any of this stuff that we went through, that's the option stuff. Price action stuff, any questions on this? Do everybody understand what I was talking about when I said like your entries and your exits? Like if we, let's go here. Let's go here for example, right here.
Thank you, grateful.
Let's go here, right? This is what I was talking about when I was saying like the price going up, right? The price going up, reading the price action, you see it went up, right? The market came down. When the market came down here, right? We was coming back up. We came here, we came down, we consolidated right here, right? We consolidated here. the market broke out of this consolidation to the upside. This was letting you know I want to go up, right? We came up, we made it low, came up, came down, ran that liquidity up under there, right? Started going back up, right? Didn't quite break that high right there. You know, we didn't break the high. Came down, ran them. So the market came down, ran these lows, tricked people to go long right here. Tricked them to go long, right? They put their stops there. Came up, hurt, stopped, came back, stopped them out, and then start consolidating. Now the market showed you, boom, I'm ready to go. See, it broke out of this consolidation to the upside, right? Over here, we broke out the consolidation to the downside, and we never broke back past it, right? So these people over here, that's why I say these people got tricked because they went up and the market just stopped. It never consolidated. It consolidated here, dropped, and took off. Right? So anybody that got long right here, they got tricked, right? The market came down, consolidated and cooled off. And then it said, now I'm ready to go up. So it broke up and then it came back on a retest. Remember I told you it'll come into the retest. It came back on the retest, right? So boom, you watching the market here, you saying, okay, we're consolidating. Boom, the market broke out. This day it closed up here. This how you know, okay, I'm ready to go long. Now you're just waiting for your entry. The market start retesting, coming back down. You watching it the next day. Okay, we're moving down. The market got to go down to go up. It's got to go up to go down. You waiting. Boom. So now we done came down and now the market going back up again. This is when you go. The market came down, came up, made a new daily high, close. The next day it opened up. This is where you go. Now you're going. And now you done bought these right here days, right? You done bought your options contract here because you consolidated. The market showed you it want to go out. It came back. You buy on your confirmation over here. It stopped going down. You got a nice bullish candle going up. You make your entry this day right here. You buy your strike for a year or two out, right? You bought it for a year or two out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 1, 2, 3. Just say a month later. You get here a month later. You over here somewhere a month later. And you done got all this profit right here. You can say, we starting to consolidate again. This don't look good to me. I'm taking my profits and going. You can close your option contract right there and take your profits. But you bought it for a year or two out. But boom, close your profits right there, take your profits, go. You don't have to hold it. Like, see, it like you got a nice run. But when you get here and start doing it, pull back and doing this consolidating, the market showing you, I'm trying to make up my mind. Do I want to keep going higher or keep going lower? I mean, start going lower. You be like, oh, I don't like how this look. I'm out of there. Close out your options contract. Wait. You know, wait. It's all about waiting. It's all about waiting. If it pull back and it take off, you know what I'm saying? It pull back and it take off. You just wait because see, it's like you're coming down. Yeah, you're breaking to the low side. See, the market showing you I want to go down right here because it broke out of this consolidation to the downside. You know what they call that up there? They call that a Judas swing. That's what ICT call it because the market showed you I want to go down, right? But it took off to the upside like that right there. They call that a Judas swing because it lead people the wrong way because the market showed you here I want to go down. So all it did was go up there and run some stops and then it came down. All right. So you always want to pay attention to what the market telling you. The market tell you what it want to do. Don't get FOMO and don't chase. Right now in the market, ain't time to be trying to buy nothing right now. We've been running for about 4 or 5 weeks now, about 2 months almost. Right now, let the market cool off. It can keep going. Like they be saying, the market can stay, The market can stay irrational longer than you can stay solvent. You know what I'm saying? So let it do what it's going to do. Let it cool off. It's been running. You got a lot of people that say, no, we're still in the bear market. Yeah, because we ain't birthed a new bull market. But the market's showing you, I want to try to go up. So you don't fight the market. Now that we've been running, let the market cool off and show you what it want to do. Because I know on the next pullback, little Timmy Rogers gonna be trying to get into some leaps. I done made a little bit of money on this little bull run, but on the next pullback, I'm gonna be trying to get in some leaps because the market's showing I want this to be the bottom. Come on down and retest, and let's go ahead and build this new Wakanda together. That's all I got, man. I like running my mouth. I appreciate y'all for pulling up. Appreciate y'all for being there. Hopefully I was able to shed a little light on something. Like I say, whenever I go live every day on YouTube, you're welcome to pull. If you can't join while I'm live, all the videos are saved. So if you just want to go back and look at them, all the videos are saved. I talk about what happened with the price action that day. I share stuff about the economic calendar, what's going on, because it's events that happen every week, every month, and on the economic calendar that affect the way the stock market move. So I cover all of that stuff on my lives too. The new TLR, youtube.com/the new TLR. And if you want these slides, go on Instagram and you can download the slides. Everybody that's in here, who I got your phone number, I'll text you a link to the slides. Say what? Oh, appreciate the super chat. Rick the Tank, I appreciate that super chat, my guy. Who on here? Yeah, I see my sweetie on there. What's up, babe? I see Here to Learn and Share. Karen, what's up, Karen? It's a couple names I don't know. Best teacher to the point and no BS. I appreciate you for that super chat. Who else? Rick. It's a lot of folk I don't know on here. I appreciate y'all for pulling up. I see some normal people in the Spider Gang, but everybody that pulled up, I appreciate y'all giving gems and plays. Oh, I appreciate you, man. If you like the gems, if you like the plays, y'all check out ICT. The stuff I was talking about, the entry techniques, I learned that from ICT. He a beast. ICT on YouTube. Inner Circle Trade on YouTube. If y'all want the slides, it should be a link in the description that says download slides. Yes, it should say download. If it's not in that link, go to my YouTube page and click on the Linktree link and look for Discipline Over Dollars slides, and you can download them. That's all I got, y'all. I appreciate y'all, man. Appreciate y'all for coming out. Oh, let me sign out on YouTube. Hey, everybody on YouTube, if you're part of the Spider Gang, I appreciate y'all for pulling up and hanging out with your boy on Saturday morning. You can be anywhere in the world, but you can't hang out with this little dude from Fort Lauderdale, Florida. If this your first time pulling up with us on the Spider Gang, join us every day. Please do so. I would love to see you. Anyway, y'all know what it is, man. Till the next time, I'm gone. Yeah. I appreciate y'all.